All right, welcome back to another episode of Asset Coach and Tax Strategist. And thank you so much for being a subscriber. If you haven't subscribed yet, hit that subscribe button. If you like our content, give us a thumbs up. Any comments, questions, please leave those below as well. So today's episode is really about business owner mindset of cash flow, understanding cash flow in a business. What are the different types of cash flow? What's the different types of terms? So we're going to go through the 10 cash flow topics that are in a business, the cash flow terms that every business owner must know. Now, if you've been to my channel and you've watched some of my content, you got to understand that we're all business owners, whether we're a W-2 employee or we're full blown, I own 10 businesses. We're all business owners. And here's why. If we want to reduce our tax liability, we need to follow the guidelines of the IRS. And the IRS tells us to be a business owner in order to get more tax benefits and tax reduction when it comes to our taxes. So we need to understand this. So we use a lot of this business language in our content here. So let's talk about this. And we're just going to start with the very basics of what's cash flow. Well, cash flow is really the movement of money in and out of your business. Positive cash flow means more money's coming in than going out. Plain and simple, done. Now, we're not going to talk about personal cash flow. Remember, this is about a business. So cash flow is money going in and money coming out. All right, plain and simple. All right, now operating cash flow. This cash is generated from your core business operations like sales and payments to suppliers and employees. Okay, so you sell a product, you sell a bunch of this widget, you get cash flow coming in from and that's called revenue. And then you have the normal costs for suppliers and employees. Okay, so that's operating cash flow. Some businesses actually set separate bank accounts specifically for this, and they have other bank accounts where they shift other cash flow to it. We'll talk about that more here. The next cash flow is investing cash flow. This cash is really used to buy and sell long-term assets, such as equipment, property, or other types of investments. So if you're building widgets and you need machinery and equipment, this is an example. You would purchase equipment. Yes, it's an expense. Yes, it's a cost, but it's an asset cash flow generating cost because it's equipment to allow you to make that widget that is going to be sold to create that cash flow. Okay, so this is really important. Now, we're not talking about the tax benefits of these things. We're just talking about cash flow. Each one of these cash flow has an actual link to how you use this that links to accounting, which leads to the tax code. But we're not going to talk about this in this episode. The fourth cash flow is financing cash flow. This is cash that is from financing activities. So money that you get from a bank or investors. These are loans, repayments. So what's that cash flow look like? So you borrow money from a bank or an investor infuses money into the business, then what's that look like? That financing cash flow, where's that go? Okay, how are we going to pay that investor back? The banks usually determine the terms. Are those good terms for our overall cash flow? That's financing cash flow. The fifth one is free cash flow. Not free cash flow that, hey, money's just kind of popping up anywhere. You planted a money tree and all of a sudden money's just showing up. No, free cash flow is cash left after operating expenses and capital expenditures. So basically what we've already talked about in the first four. Now, it's the cash you can use to help grow your business or pay down debt. So you have free cash flow. So in our conversation, when we talk to our members, is we have revenue, expenses, and then we have cash flow. That's what this is. This is that free cash flow. This is, okay, what do I do and how do I deploy this cash flow? Do I go invest it in other equipment? Do I go invest in it under other widgets? Do I go buy another business? What do I do with this free cash flow? Do I hire people? What do I do? That's the free cash flow. Number 6, cash conversion cycle, CCC. Cash conversion cycle. The time it takes to convert your investments in inventory and other resources into cash from sales. All right, time out. All right, so you're selling a widget. You know, based on how your sales of widgets, your historical sales of widgets, you know the time that it is finished, that widget's completed, to the time that it's delivered to a customer. Okay. So that time you're like, well, you know what? We got some things coming up. Hey, there's a peak in the year. So sometimes the peak in the year would be like holiday, like Christmas time, where there's a lot of sales. So we maybe over the year, we build a little bit more widgets and we inventory more widgets. Okay. What's a time that it takes to invest in this inventory and get it to the customer? So there's different things where it used to be where people used to have a lot of inventory because it's still an asset. But now with Amazon and what they call just in time is you make it now so it's not sitting in inventory, because yes, it is an asset, but if it doesn't get sold, if it doesn't get moved, now you got a bunch of inventory. What are you going to do with it? Now you got to scrap it. Now it's no longer an asset and it's got to convert to a different part of the business cycle. Okay? So cash conversion cycle is important to understand that timeline. So let's say you're not building a widget. Let's say you're offering a service. Awesome. When you send out an ad on Facebook, TikTok, or wherever, however you do an ad or you do a talk, right? What's that time of that trend, that lead, that marketing leads to a customer? What's that cash conversion? I invested in marketing. I have now customers. Okay. That's kind of an important understanding to know that timeline, because that allows you to know when you have free cash flow, I think we're ready to increase our sales. And in order to increase our sales, we need to do more marketing. We need to get more people to buy our product or our service, right? So when we have our free cash flow, we need to understand our cash conversion cycle, what that looks like. Number 7, cash runway. Okay. Yes, it sounds like what it is. This is how long your business can operate with the cash you have on hand. Okay, so we have free cash flow and we look at all our expenses and we say, hey, if we weren't to sell another thing, if we were not to generate any additional revenue, how long could the business survive? This is such an important thing because a lot of businesses could not. Well, that doesn't mean they're a bad business. It doesn't mean that they're not a successful business. Their business model could be structured around to where they have no runway because of the flow of the cash conversion cycle and how they've built out a plan to deploy this free cash flow into other areas of the business. Okay. Or in distributions to the owners and shareholders, right? So cash runway is you don't have to necessarily sit there and go, man, if we didn't earn any sales, we'd have to close the doors next month. That's okay. That doesn't mean it's a bad and not successful business, right? Because of what you're offering, whether it's a product or a service. You just need to know that, okay? It's different for everybody. But that cash runway is also important. So if you're somebody who are like, man, I am working 12-hour, 14-hour days, I need a break. My wife is frustrated. I'm frustrated. Well, and if you don't have a cash runway where you can go take a week, 10 days, 2.5 week vacation, just get away, staycation or vacation, does not matter, and your business can't succeed, then you may need to focus on your cash runway so you can not be burnt out and you can keep that energy flow. Okay. Number 8, accounts receivable. This is such an important aspect, especially where we have a lot of members that are in the medical field and they work with the insurance companies. And one of the things they don't teach you when you get started in your business is the accounts receivable aspect of, hey, when I meet with a patient, it may take 90 days for the insurance to reimburse me, right? So do I have cash clients? Do I have deductibles that I collect? Do I have enough capital or financing to create this cash runway till the conversion of cash cycle and we get cash flow into the business because the insurance paid? Okay. So, but accounts receivable is money owed to your business. Okay. By customers for goods or services sold on credit. Now, when I say by customers, again, it could be based on the insurance company's reimbursements, right? So we want to make sure that you understand that aspect of it. Now, if you're not dealing with insurance and you deal with payment plans or some type of self-financing, you need to understand and account for your accounts receivable. Now, this is really important. Accounts receivable and accounts payable, which is the next one, number 9, this is really based on understanding, are you cash basis accounting or accrual basis accounting? The numbers are treated differently. And so it's important to understand on how you want to pay taxes or recognize revenue, whether it's cash based or accrual based accounting. Most service businesses are cash based. There's a lot of businesses that are cash based. Doesn't mean that there's not a lot of businesses that are accrual. It's really based on your business model and what you and how you want to recognize and structure your business cash flow. This is really important to talk to your CPA, your team about, as well as your tax team. So if you have accountants and bookkeepers that aren't focusing on the tax, they're just focusing on the transactions of bookkeeping and accounting, then you really need to get your tax people involved and talk about, what do we want to do? Do we want cash or accrual? It's an important aspect and understanding of how you want to run your business. And then you got to commit to it too, right? All right. So accounts receivable, very, very important. So for example, here we're a member-based, subscription-based model. So when we bring on a member in month 1, we count accounts receivable for 11 months. Okay, so we're in this current, so it's cash because we're cash basis. So we get cash today, but because it's a membership and it's a 12-month agreement, we have 11 months of accounts receivable. Okay, so when we look at our financial statements, we're looking at that and go, oh, okay, here's what our accounts receivable. So here's what our cash flow looks like, our revenue, but here's our receivables. Then we can look at this financial model of what our business is, and we can make decisions based on the cash runway, cash conversion, free cash flow, etc. Okay. Number 9, accounts payable. This is money that you owe to other suppliers and vendors for goods and services. Okay. That you've already received. Okay. So these are your payment plans. These are where you're buying on credit from a supplier, for example. Now, for us, there's a couple things that we have in place. So because we're a membership organization, we also include certain services in our membership. So like our coaching. We provide coaching as part of membership. So we have a coaching business that when we bring on a member, there's a certain percentage of that member due that goes to the coaching company. So when we bring on a member, we now have an accounts payable to the coaching company for 11 months. For our accounting team, for Credo, our accounting team, same thing. We offer certain benefits in membership on a monthly basis that accounting is part of that. Okay, so we have a certain percentage of the membership dues that now goes to accounts payable to the accounting company, to Credo. Okay, so this is important. Get in revenue. You bring in a new member. In our situation, we have revenue. So we count this month. Then we have counts receivable for 11 months. And then we have counts payable for 11 months to those other organizations. Okay, so when I look at those organizations and I look at our Terra Firma's books, then I can look and match up and look at the health of what our business looks like. Okay, important to understand that from a cash runway and a cash conversion cycle. All right, finally, number 10, cash reserves. This is emergency savings. This is money that you've set aside for unexpected events, expenses, or financial downturns. So there's an economic situation. So this is hard. This is really hard to predict. And so the best way to be able to predict what your cash reserve should be is looking at your historical business. And so if you've been in business for 5-10 years, you really should look back and look at those moments in the years where there's been financial issues, whether it's economically or in your business or suppliers, right? Has that put a crunch on your business? And so you should probably have some sort of cash reserves set aside to focus on that. Now, where do you put the money and set it on cash reserves? Well, you could decide on how you want that structured. You could have short-term, long-term. You could use credit as part of the cash reserves. So you have your free cash flow going into the business, but you have lines of credit just in case. So it's not actually real dollars that are being affected by inflation, but you're using finance dollars. But if you have a line of credit, you don't pay any interest on it unless you use it. But it's sitting there as your cash reserve. Now, one of the problems with that is that if there is economic downturn, there is a struggle on the banks. Sometimes what banks do is they terminate credit limits. Okay, so in 2008, that's one of the things the mortgage companies, banks did, is that they eliminated the access to equity line of credits. If whatever you had as a line of credit got terminated. So if you had $100,000 HELOC, for example, and you used 30 grand, that other 70,000 that you had available in your HELOC line of credit, they eliminated. So you just had that 30,000, no, nothing else. Okay, so that's something to be mindful of in certain situations, especially if you're economically sensitive to. So for example, if you're a restaurant, right, that would be a good example. People eat out when they have economy is good, they have free cash flow personally, they eat out. If not, they buy groceries, they eat at home, right? So you as a restaurant should probably have some sort of reserves, both short-term cash that you have, but also lines of credit that can use for longer term runways. So anyways, hey, hopefully this was helpful. This is important to understand that mindset. And it's also important for you to understand what businesses are going through or should be going through when they're thinking about offering you a product or service. What's this look like? Okay, it's very important to have this knowledge because cash, the old adage, cash is king, is not true. The flow of cash is king. The economy, the economics, capitalism is about money flowing. Your personal situation, when you look at your tax return, it's a summary of how your cash flow, your income flows through the rest of your life. Okay, so you cannot have money just sitting there. I like to use the analogy as if you're walking along with your significant other and you look over and there's a body of water. And there's a bunch of algae and bugs, and it kind of has an odor, a stench to it. Why? Because that water is stagnant. It's not moving. It's just sitting there. Okay. But the moment you take running water, a hose, you put it into that stagnant water, what happens? The bugs go away, the algae goes away, the smell goes away. What was the difference? The movement. Cash is the same thing. The flow of cash is king. That's why this is so important to understand and have that mindset of what this means. So there always has to be flow of cash. Now, when it comes to investing in the type of asset you're investing, then we start leading into the rules to that asset, accounting, and taxes. Because taxes allow for additional cash flow because you get tax benefits from certain assets. So that's essentially a receivable when you think about it, right? We don't account it as a receivable, but you can think about, hey, if I'm going to get a tax benefit because I bought this asset, but I didn't get the results of that tax savings yet until I file my tax return, that's a receivable mentally, right? So anyways, very exciting. I always thought accounting was boring and stupid and blah, but when you start understanding how this affects you and I, and how this is really part of the planning process, accounting really starts going from black and white to color. It starts popping off the page because you get to now start planning and strategizing, and you get a little excited and you kind of get a little skip in your step. At least you should. If not, don't worry about it because it is accounting and it could be extremely boring. But thanks so much for spending your time with us. I appreciate it. Hopefully this was good information for you. Again, don't forget to subscribe if you haven't. Give us a thumbs up. And until then, go make it a great day. Bye-bye.